Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I am Arjun Patsati. And in today's podcast, we will talk about what are the options for 1 to 2 year maturity bonds, which are the most favorable investment options for investors, fixed income investors at this point of time in the current interest rate scenario. Just before I start, please do download our app Quick Invest by INR Bonds, where you can get the best bonds in the 1 to 2 year maturity bracket, which could fit into your investment profile. You can download the bonds on iOS and Quick Invest platform app from iOS and Android on iOS and Android. And the link in the description here will take you to the download link if you require. And all you need to do is open the app, check the bonds available, see the information, and go straight to the investment. And obviously, you have our support whenever you require. Uh, then going forward, the current interest rate scenario looks clearly uncertain for investors. So many things are happening. One is that inflation is high, with oil prices touching close to 100 on the Russia-Ukraine standoff, and supply is also tight. Energy prices across the world are rising. Inflation in the US and Eurozone are at decade highs, many decade highs. Rate hikes all over the place. In India, you have government coming in to borrow record amounts for the next fiscal year. And you also have the threat of inflation, global inflation spilling over to India. And so many different, and also the rates are very low and much below inflation. The core inflation is at 6%, while RBI has kept rates, repo rate at 4%, 2% below the core inflation. And this is hurting savers and investors, fixed income investors. So in the clearly with this uncertainty, investors do not want to take any risk with high long maturity bonds, where because we don't know where the interest rates will go in the next 1 to 2 years. And also, but having said that, if you take the short maturity bonds, including government bonds with below 5 years, they're all below 6% levels. Then you have the Bharat Bond ETF, which is the mix, which is a index of PSU bonds. Now, this is a very good investment option for investors, but the yields are very low, below 6% again for the 2025 bond, and 2023 1 year bond is below 5%. So all this is hurting investors. And so even if you take high safety NBFCs like Bajaj Finance, AAA rated HDFCs and LICs, 2 year bonds are at below 6%, 3 year bonds maybe higher than 6%, but not too high and not very comfortable. 5 year bonds at below 7%, but 5 year again, you're taking a higher interest rate risk. So hence the options now go to the lower rated bonds. And here there are many issuers coming in to raise funds. So recently we had a public debt issue of an NBFC InCred, which is a 1 year, 1 year or 1.5 years bond, over 9.5%. Then you have regular NBFCs issuing bonds over 9%, like Navi Finserv and others. Microfinance companies have been issuing bonds at 9.5 to 10% for 1 to 2 years. And so are many other NBFCs. And the MLDs, market-linked debentures issued by entities like Vivriti and uh, many other companies are also finding a lot of favor, especially these issues are all in the 15 to 24 months category, and the price anywhere between 9.5 to 10.5%, depending on the issuer. So you have private placements like uh, um, uh, private placements happening on MLDs. Some of the regular MLDs issuers include Vivriti Capital, you have Navi Finserv, Then you also have many microfinance companies like Muthoot Microfinance and Ashirwad Microfinance. All of them issuing MLDs. Sriram Group has been issuing MLDs. Um, then you have um, many others too issuing market linked debentures. And so these are also finding a lot of favor with investors. In the last in the last uh, week, you have private placements, not in the 1 to 2 year bucket. For example, Tata Capital came with a 10-year issue. This was priced at 7.5%. Again, 10 years is high interest rate risk. We had LIC Housing coming with 5-year issues at closer to 6.7%. Again, carrying interest rate risk, though not credit risk. And many others coming into the market to raise funds. So clearly, the options available in the 1 to 2 year maturity buckets would be issuers like, for example, in Quick Invest, we have issuers like Swatantra Microfinance, the Birla family run company, Ashirwad Microfinance, which is a Annapuram uh, subsidiary, and Muthoot Microfinance. This is part of the Muthoot, uh, not Muthoot Finance, Muthoot FinCorp. So, and you have the Shriram Group. You have bonds like UPPCL, Uttar Pradesh Power Corporation. You have Navi Finserv Housing. So obviously, each of the issuer carries credit risk, and it's up to you to judge the credit risk. Uh, 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 the information is carried as we are within our own Quick Invest provides you a proprietary risk score where we rate the issuers based on various parameters, and we give a low, moderate to high risk. So the best options would be moderate risk bonds in the 1 to 2 year maturity. If you can get yields of over 8%. Then you have Aadhar Housing Finance, which is owned by Blackstone largely, and uh, these bonds were offered and traded at 7.3% for 1.5 year maturity bonds, while the 6 months maturity bonds were closer to 7% or below. But these bonds come in bits and spurts. They're not really being issued by issuers at this point of time. And hopefully, we should see more and more issuers coming in to issue bonds maturing in 1 to 2 years. And this will find a lot of flavor with investors, provided the bonds have the correct risk uh, parameters. Investors obviously have, and financial advisors mostly will have to uh, understand the credit risk of each bond uh, and then take an investment decision. Um, yeah, that's it to the end of this podcast. Thank you for listening in, and do follow us on YouTube, Spotify, Apple Podcast, and Amazon Music. Thank you.